Welcome students, this is Damien Angelo Labro here. In this video, we'll be looking at a basic introduction on what is financial statements and the purpose of these financial statements. This video is important for the students who are in the introductory level of financial accounting. Understand the purpose of these financial statements and also the logic behind the format of these financial statements. Okay, so with a proper understanding on the financial statements, you would find it very easy for you to do questions on the financial statements later on your studies. Now let's see, why do we need financial statements? The main objective of financial accounting is to provide financial information for the decision makers. Now we need to have a set of tools in which we can provide this information. So these tools is your financial statements. Now in a complete set of financial statements, you have 5 components. The first one is a statement of profit or loss. The second one is a statement of financial position. The third one is a statement of cash flows. The fourth one is a statement of changes in equity. And the fifth one is the notes for the financial statements. Let's start with the first one, which is the statement of profit or loss. Now the statement of profit or loss will evaluate the performance of the organization during a certain time period. Now this time period is what you call as the reporting period or the financial period. For an example, we will look at all the incomes and expenses to see the performance of the organization during the time period from 1st of January to the 31st of December. That's a 12-month period. That is called a financial year. So if your financial year starts on 1st of April, it will end on 31st of March. 12 months time period. Okay. Now when you look at performance is measured through results. If you take a batsman, the batsman's performance is measured based on the marks the batsman scores and the strike rate that the batsman maintains, right? When you consider yourself as a student, your performance is measured based on the marks that you get on your class test. For a business, what is the result? The business, their result is profits. So the profit that the business is generating will decide if the organization is a performing organization or a non-performing organization. Clear? Now in your student progress card, you receive your marks for each subject. Your performance in each subject contributes to your overall performance, right? When you say overall performance, it's your class position and your average. Okay, if it's a degree that you are pursuing, the first class or the second class of the degree is basically decided based on the performance of your subjects or the modules in your degree program over the time period, right? So with the grades for your individual subject given to you, you will be able to identify the areas in which you have been. So you can take actions and plan ways and means where you can improve on these subjects which you are weak at. By that, you can increase your overall performance as a student, right? Now for an organization, the performance is the profit. The profit is determined based on 2 variables, which is the incomes of the organization and the expenses of the organization. The statement of profit or loss will provide you all the information about the incomes and also the expenses of the organization and the profit that you created during that financial period. So if you need to increase your profits, you need to improve in your income, or you will need to reduce your expenses. Okay, to begin the process of improving your income and reducing your expenses, you first need to have an understanding on what are your incomes and expenses. So the statement of profit or loss will provide you that understanding. Now, as an individual, your life can be measured at different tiers based on different activities you do. First, you as a child, then you as a student, then you as an athlete, then you as a parent, then you as a spouse. The way that you perform in all these different activities will determine your overall performance at the final day. Okay, so when your time is right, when you go back and you see at these levels of activities, you will feel whether you have been a good performer in your life or whether you are a bad performer. Similar for an organization, there are different tiers in which we can see these activities. The main business activity for a business is the trading activities, where we buy and sell goods. Yeah, let's say you start a mobile store. Now the mobile store is buying 40 mobiles at $200 each, and they only sold 30 mobiles for $300 each, right? Now guys, how do you calculate profit? Profit is income minus expenses. So from one mobile you create an income of 300 and the expense was how much? 200. So per mobile you will create a profit of 100. So you sold 30 mobiles, which means you should create a profit of 3000. Okay, so look at this calculation here. I have taken the income from 30 units, which is $300 into 30 units, 9,000. Now when I consider the expense, I have only considered the expense of the 30 units that you sold. We are looking at the performance during the time period. So when you assess the performance of the organization in terms of the trading profit or the gross profit that it makes from its buying and selling activities, you only need to look at the cost of the goods that you sold, not the total cost, right? Now when you look at this stock, you purchased how many units? 40 mobiles, and you sold 30 mobiles, so you are left with 10 mobiles now. These 10 mobiles is not yet an expense for you because you are not used it to generate income. Okay, but it is there in your organization as a resource that would create probable future economic benefits. So that 10 units, the closing stock, is not an expense, it is a asset. So you should not consider it as a cost of the goods sold, right, during the time period. Remember, when you calculate gross profit, you are only taking the cost of the goods that you sold. The closing stock should not be considered. The mobile store will need to properly administrate and support the trading activities. Like they have to pay the rent, they have to pay electricity, they have to pay the staff salaries and wages, right? So that these trading activities can occur. So these activities where you manage your organization and you maintain your premises is called administration activities. Then as a organization, you will have to create social awareness and you will also have to distribute your goods and services to the customers. Now to create social awareness, you will have to run promotions, you will have to run advertisements, and you have to provide commissions to the sales staffs to motivate them and to sell more units. So by doing this, you can increase your revenue, and by that means you can increase your trading profit. If the service is provided, the organization might deliver goods to the customer. They might have different outlets, so they will have to distribute these goods to these different outlets. This distribution activities is carriage outwards, where you are distributing goods to others. You are carrying your goods outside of your organization, right? These expenses, you call them carriage outwards. Now, carriage outwards and any other distribution related expenses like motor vehicles and all of that is considered as distribution activities. So both the selling activities and distribution activities are considered together as selling and distribution activities. Now let's look at the operating activities of an organization, the second tier. We looked at trading activities, which was the first tier. Now we are looking at the operating activities, which is going to be the second tier in your organizations. Now the operating activities will include the trading activities plus any other income. Now other income is revenue that is generated by the organization that is not from the main business activities. Like for an example, let's say you have a building with 5 stories and you are using only 3 stories. So you are left with 2 stories. So these 2 stories you can rent it out and you can create a rent income. So this rent income is an income created outside your main business activities. So you will have to add this to your profit from your trading activities. Then you will have your administration activities and selling and distribution activities. All these activities together, you will have your operating activities. So let's look at this with numbers. Let's say your trading activities created a gross profit of $3,000 and you have other income of 1,000. So 3,000 plus 1,000, you will have total economic benefits of 4,000. Then you have administration activities and selling and distribution activities where you have spent money. So you have spent 2,000 on administration, 500 on selling and distribution. So altogether you have spent 2,500. So from 4,000, when you reduce 2,500, you will have the operating profit of 1,500. Now guys, for you to do all these operating activities, you need money. So you will need to finance your organization. Finance means you'll have to take loans. Now guys, a loan or a lease will not come free. There is going to be a cost associated with it. Okay, so these costs will be removed from your operating profit. Then you will arrive at the net profit, which is the final profit of your organization. So you look at 3 levels of profit. One is the trading profit, the second one is the operating profit, the third one is the net profit. Okay, so here in this organization you have a gross profit of 3,000, which is coming from your trading activities. Then you have operating profit of 1,500, which is your coming from all the operating activities. And then after reducing the finance expenses of 500, you have a total profit of $1,000, which is your net profit. On screen you have 2 organizations. One organization has assets of 45,000, where capital is 40,000 and the liabilities is 5,000. So the owner has introduced 40,000 to the business, and other people from the external parties, you have only received 5,000. Okay. Now if this organization is to go bankrupt, there is enough capital to pay off the liabilities. Okay. Even after paying the liabilities, the owner will still have 35,000 rupees for himself. Okay. So what do you think about the financial health of this organization? Is it good or bad? It looks to be a very healthy organization, right? Let's look at the second one. The assets is 45,000 again, but the capital is 15,000 and the liabilities is 30,000, which means 2/3 of the assets is given to you by the external parties, right? Now if the organization goes wrong, do you have enough capital to set off your liabilities? No, right? 2/3 of the company is owned by external people. So guys, if it is not a limited liability company, the owner will have to sell his own personal property to settle off this business debts. So what do you think about the financial health of this organization? good or bad? The financial health looks to be bad, right? So this is what the statement of financial position is looking at, right? So the lower the share that is owned by external parties, the stronger the financial position of the organization, right? Now, when you look at these three elements, assets, capital, and liabilities, what comes into your mind? Yes, the basic accounting equation, which is assets equals capital plus liabilities. This is the graphical interpretation of your accounting equation, right? Now guys, unlike the statement of profit or loss, we are not looking at a financial period. We are looking at the assets, capital, and liabilities as at a certain date. So this is like a snapshot of your assets on a certain date, the snapshot of your liabilities on a certain date, and your capital at a certain date, right? So on screen there is the format given to you. So see, there is the total assets, then below you have your total equity and liabilities. The assets should equal, the total of assets should equal to the total of equity and liabilities. Now there are a few important terms that you need to know in related to this financial statement. Okay. Now when you look at the asset section as well as the liabilities section, you can see two elements which is called non-current assets and current assets. The same thing under liabilities, non-current liabilities and current liabilities. Guys, non-current assets and liabilities are the assets and liabilities that stay with the organization for a period just more than 1 year. Right now, when you buy a motor vehicle, you use it for 2-3 years. So it is a non-current asset. If you take a bank loan, you will take about 3-4 years to settle it. So that is a non-current liability. Then current assets and liabilities are the assets and liabilities that stay in the organization for a period less than 1 year, like your cash. Now your cash, you will use it for your business activities. So your cash will stay for a period less than 1 year. Right? Your trade receivables, you have to pay, you will try to recover the money as soon as possible from your trade receivables. You are not going to give credit for years and years. Okay, you will give credit for months. So period less than 12 months. Then you will have trade payables. You will have to pay your creditors, right? And they will not give you years to pay it. You will have to pay it within months. So that is a current liability. So guys, when you look at this current assets section, when you record the transactions, you need to record from the least liquid asset to the most liquid asset. Now, when you say liquidity, it is the ability to convert an asset into cash. Now, when you look at inventories, to convert inventory into cash, you have to go through a rigorous process of advertising, promoting, right, and all these supporting activities together, right? It's not easy to convert inventory into cash, right? So the least liquid asset of the organization is going to be your inventory. Then when you look at your cash, the cash is already in your hand. Okay, it's already converted into cash. So there's nothing to convert. It is the highest liquid asset, right? So when you look at the format that is given to you on screen, on the top you have inventories because that is the least liquid asset, and on the bottom you have cash in hand because it is the most liquid asset, right? Next to cash in hand, the liquid asset would be cash at bank because it's just a matter of going to the bank and taking the money, right? Clear? Now let's look at the statement of cash flows. The statement of cash flows will show the movement of cash within the organization during a certain time frame. Okay. Now the first section of the statement of cash flows will look at the the cash flows that is generated from the operating activities of the business. Now, to calculate the operating cash flows, there are two methods. One is the indirect method and the other one is the direct method. Now, there will be a separate video that will be uploaded on the statement of cash flows. So subscribe to the channel and press on the bell button so you will be notified when these videos are available. The second element of the statement of cash flows is the cash flows from investing activities. Now, when you say the cash flows from investing activities, it is where you invest money to get returns, like buying non-current assets. So when you buy non-current assets, you will spend cash. It's a cash outflow. So you will remove the investments that you make on your assets, or maybe on other company shares, or maybe on fixed deposits, right? And then you might sell some of your assets, your non-current assets. So when you sell your non-current assets, you will receive money. So those are cash inflows. So they will be added under your investing activities. Then on the third section, we have the financing activities, where we take loans and how do we finance the business. So this will include when you take a loan from a bank, you are getting money. So this will be shown as an addition or a cash inflow in your cash flow statement. Okay, and then when you pay back the principal amount of the loan, right, then what happens? Your cash is going out. So this will be shown as a cash outflow in your organization. So with all these activities considered, you will calculate your net cash flow, and end of the day, the closing balance should equal to the balance of your cash account, right? So the next statement is a statement of changes in equity. So this statement is looking at the changes in the equity of the organization during the certain time frame, right? So this is basically used for limited liability companies. So you will learn this in detail in our video that is on limited liability companies. Okay, so tune up and subscribe and press the bell button so you will be notified when those videos are available, right? So that is the statement of changes in equity.